Now, the people in this room are responsible for devising complex strategies to choose, to hedge, to diversify, to optimize so many factors like liquidity, time horizons, access, and so many more. But this is a very complex business. It's difficult to make sense of it, and then you put the public and private markets, the interplay between them, and the role that alternative investments play. It becomes a very complex picture indeed. And the question is, how do we make any sense of it? I will tell you how. We invite Martin Matsui to come and join us with his panel. Martin is the former Chief Strategy Officer of the Exchange Fund Investment Office. He's ready to go, and here they come with the HKMA. He's joined today by Nicolas Giauque, who is the Managing Partner and Chief Investment Officer at Farallon. Also joining us is Chris Gradel, who's the co-founder and CEO of PAG. We've had his other co-founder on this stage a few times. And Tony Yoseloff is the Managing Partner and Chief Investment Officer with Davidson Kempner. And with that, we're ready to go. Martin, please take it away.
Okay, thank you very much. First, what I would like to do is just set the stage for this panel on liquid alternatives. So we've heard a lot about illiquid alternatives, private equity, and real estate in previous sessions, and now we would like to turn to liquid alternatives reconceptualized. And for that, to set the stage, I had three quick slides I wanted to show you. The first one is just introducing our panelists, where they're located, how long they've been in business. So it's a 20 to 40-year story with presences in San Francisco, New York, and importantly with Chris in Hong Kong. And you can see the AUM figures on the board as well. So next slide is regarding what I am referring to as the hedge fund or liquid alternatives world with respect to the traditional asset classes and illiquid alternatives. So you can see that if you add up listed equities together with liquid fixed income markets, you wind up with a figure of close to 250 trillion US dollars. And that compares to roughly private equity and real estate markets, which we've been talking about, which are about 10 trillion. So hedge funds, AUM is roughly 4.5 trillion. So those are the relative orders of magnitude that we're talking about. But the influence of hedge funds is much larger because of the use of leverage, which we will talk to a little bit later on. And the final slide, which will lead up to my first question to our panelists, is recent performance of hedge funds, volatility, correlation to long-only markets. And there the story is, for the industry as a whole, attractive returns, low volatility, and in fact, these panelists evidence even lower levels of volatility, and low to negative at times correlation to equities. So the first question that I'd like to ask Nicolas is, what is the role of hedge funds in an investor's portfolio? So when I was previously at HKMA looking at the hedge fund portfolio, it had characteristics, this is 20 years ago, of absolute return asset class, so LIBOR plus 5. And then 2009 happened and the portfolio was down, the market as a whole for hedge funds was down close to 15%. So absolute return and then minus 15%. And then since then, it's known more as a alpha asset class. So Nicolas, what is your view on the right way of thinking about hedge funds in investors' portfolio?
Thank you very much, Martin. And of course, thank you to Hong Kong and the HKMA for having us. And congratulations to the HKMA for the fantastic organization of this event. So thank you. I think hedge funds encompass a wide variety of strategies, so maybe it's easier to describe what we're focused on delivering. And of course, the first and foremost, what we're delivering is excess return. And when I mean excess return is a return that we generate above the systematic risk that we take. I think we've been having a lot of discussions over the course of the past day and a half around the big systematic risks and shifts in the world. And what we're trying to deliver is uncorrelated alpha generation. And so when I'm thinking about our portfolio, it's about whether this management team in this listed company in Japan will actually follow our proposals which will enhance value. It's about whether the antitrust regulator in this merger will approve this specific deal or not. It's whether we, with perhaps a few other creditors, will be able to restructure the balance sheet of this company or that company. And so the sum of all those idiosyncratic risks should be uncorrelated to systematic risk factors, and that's how we generate returns. And so indeed, I think the 500 basis points over SOFR is a benchmark. I think the expectations of the industry as a whole is also to at least match equity markets over long periods of time. It's a little bit harder when they are going up 20% plus a year every year. But that's certainly the target with a volatility which is much lower than that. And so we provide this excess return, uncorrelated idiosyncratic risk, and that allows people in this room, allocators, to build a portfolio on that. So beyond the excess return that we provide our LPs. We don't think of them as client, we think of them as partners, to build a portfolio where they can take more risk, take more systematic exposure, say on the AI trend, say on the energy prices trend that might happen in the US, outside of us, and they can take that directly, perhaps in a different fee structure, and we are a complement to that. I think we also provide, as hedge funds, liquidity appropriately for our LPs when there are drawdowns, because hopefully we have more upside capture than downside capture. And finally, certainly as a multi-strategy fund, we have a business, of course, with an office in Hong Kong. We've been here for a long time. Actually, this is where I started my career in 1994. But we have businesses in Europe, of course. We're based in the US and in Latin America. And we do, all the strategies that we do, merger arbitrage, we do fundamental strategies, we do credit, all of those around transitions. We capture transitions in corporate events, in businesses, in regions. We have a lot of bottom-up intelligence on big trends, which help our clients, our partners, allocators, to build also on their portfolio. So I think that's what we provide as well, market intelligence that's very live.
Okay, good. Yeah, thank you. Chris, from your China chair, can you give us your view on the role of hedge funds?
Yeah, I mean, when I guess I first learned what a hedge fund was in early 1999. I did an internship at a small $400 million hedge fund in New York called Millennium Partners, and I thought, wow, this is really cool. Generating low volatility, absolute returns. I thought, wow, that's actually what got me excited, really, in the investment world. And, we, PAG, started as a hedge fund business in Hong Kong. And hedge fund is still an important part of our business. We're more diversified now as a firm, also across private markets. But on the hedge fund side, the business has evolved, but I think at the core of our hedge fund business is generating absolute returns, not losing money, low volatility, low correlation. That's what we're trying to do. And if we can generate, low double-digit returns with low volatility and correlation and liquidity, and there's a lot of hedge funds these days who don't offer liquidity anymore, even though I do think that's an important part of the value proposition of a hedge fund. I think, why wouldn't you want that in your portfolio, right? I think that's a product that should be in every portfolio. And our hedge fund business has evolved a little bit over the years. I think two sort of big changes in our hedge fund business. One, we started, in 2002, and we started doing more also private debt type investments through our hedge fund. And I have to say, it's why I'm a huge skeptic on these semi-liquid products, these sort of retail wealth products on privates, because from personal experience, managing liquid investments in an open-ended structure is extremely difficult. And, we decided we would not do that anymore. Open-ended funds are liquid. Illiquid investments go into closed-ended funds. So that was one change. And secondly, we now manage 4 different hedge fund products. And 2 of them are CIO-driven. So there's an individual who's really driving that strategy. And I think they're super talented, doing an amazing job. And then we have two products which are related, which are multi-manager, which is more the Millennium, type model where we have 70 portfolio managers running different strategies, and we allocate capital. And I think, there's room for both of these models, but they have their pros and cons. But I'd say, the objective is always to generate those absolute returns. We're not again, there's lots of different flavors of hedge funds, people who take different levels of directional risk. Our products, we don't, and I think it's something that can fit in multiple portfolios.
Okay, thank you. Tony, how would you answer that question? And maybe you can reference your recent research piece on hedge fund behavior in current higher interest rate environments.
Yeah, sure. Happy to. First, as a starting point, though, thank you to HKMA for hosting this amazing 2-day series of events and for inviting me to speak here today. I spent a lot of time thinking about this question. So I've been at Davidson Kempner since 1998. I was 24 years old when I joined. And there was a dramatic change in how people think about the role of absolute return in their portfolios in the last 10 years or so versus in the early days of my career. In the early days of my career, absolute return was thought as both a return driver in the portfolio, but also a ballast and a volatility mitigator. So the expectation was that you should be able to earn at least the rates of return that you want to earn on your overall portfolio from absolute return, but it should provide other benefits to the rest of your portfolio. I mean, the reality is, while beta may have had a good several-year stretch, most allocators can't only own beta. Most allocators have a spend rate. You have to actually spend roughly 5% of your assets plus or minus in a year to meet your mission. That works very poorly with beta because there's very high volatility in terms of those returns. Absolute return strategies allow you to mitigate that volatility. So if you were to look at the role of absolute return strategies, or at least as allocators thought of them in the second half of the 2010s, so let's say 2015 to 2019, people still considered the volatility mitigation and the ballast characteristics of the portfolio, but they were a little bit less driven by the return portions of the portfolio. And the idea was we were going to make our returns in the equity-linked strategies, so private equity, venture capital, growth equity, maybe public markets, and we only expected AR to basically be a mitigator. Obviously, in a year like 2022, and quite frankly, in the last 3 or 4 years in private equity and venture capital strategies, that's been a terrible idea because those strategies have actually produced very little rates of return. Venture capital, as an example, has good decades and bad decades. You made a lot of money in venture capital in the 2010s and the 1990s, and you made practically no money in venture capital in the 1980s and the 2000s. Like, these things go very long periods of time. And so the last 3 or 4 years, absolute return strategies have been the best return driver, quite frankly, for most portfolios, especially once you include 2022 in the mix. And so the question I tried to answer is, like, why is that the case? And so we looked at over 30 years of Cambridge Associates data on rates of return. And what we found out is that there's a very high correlation between where interest rates are and what returns you can earn in absolute return. But it's not just a 1-to-1 ratio. You actually get an extra oomph in times with higher interest rate environments for absolute return than you get in lower interest rate environments. And the reason for that simplistically is dispersion in markets. You have a lot more dispersion in both equity markets and credit markets in higher interest rate environments than you have in lower interest rate environments. And interest rates do simplistically cause there to be winners and losers in markets. And if you look fundamentally about what an absolute return strategy is, whether it's a relative value strategy or whether it's a event-driven strategy, fundamentally it's in the difference between separating winners and losers. And so I personally think the 2020s, and you've seen this in the returns in the last 5 years, are a decade of absolute return being a very strong strategy in a decade where people are going to be able to look to absolute return to at least earn the overall rates of return that they expect to earn off their portfolios. But it's not random in terms of why this has happened this way. It really is about the record rise of interest rates that you had in the Western world in 2022 and 2023. And I think that story has many years of legs to it. And we did publish a white paper on this, which is available on our website.
Right. Okay. Thank you, Tony. So, Nicolas, Chris mentioned earlier the subject of credit, and there's been earlier discussion regarding where we are in the credit cycle, and your industry and fund have the ability to look at a variety of private credit asset classes, ranging from distress to loans to leveraged buyout companies. So, I guess, where do you think we are in the private credit cycle, and what do you think of the entrance of private credit funds into your business?
Thank you very much. So credit is a, and certainly the credit cycle is a multifaceted question. Obviously, we do and we invest in credit as part of our hedge fund with liquidity available to our LPs in the second, where we do a lot of trading in the secondary market. And there, obviously, we are in a world of very, very tight credit spreads. I think probably in the bottom 10 decile of credit spreads in the history. So there's very little. There's a lot of financing conditions. Let's put it that way, are very positive and accommodative. But at the same time, the percentage of credits which are going through restructurings, either in court or out of court in the U.S. and Europe, at 5-year highs. So there's a mix. There's a mixed opportunity set here for us. Well, there's an opportunity set for us in our restructuring business, less so in the new origination business. I think the question that you're asking is about, the benefits of investing in private credit perhaps now, and how that's competitive. Some of the asset managers that we've heard before are competitive with what hedge funds and our private capital does. We are more in the special situation business. We're looking for assets that we don't need to lever in order to generate our double-digit rates of returns, and so that is the intrusion of private credit has been a competitor to the loan market, the syndicated loan market, to the bank market. And there I would just say that, there is sort of an all-powerful laws on future returns for credit. Yes, they are. They start off with your current, with the spread and the total return at inception, the yield to maturity, and your expected loss. And we are at all-time lows in terms of credit spreads, and rates are likely to come down. And at the same time, the past 10 years worth of losses are at, in most U.S. and European markets, are historical lows as well. So future returns might not be as good as past returns.
Thank you. Tony, what would you say to that question about where we are in the credit cycle, and what do you think about the entry of new private credit players in the market?
Well, in terms of the second question, credit is a very broad asset class. And so I think the place that you've had the most impact of private credit has been in direct corporate lending, particularly in the United States, where you've got a direct corporate lending market that is give or take the size of the bank syndicated lending market, depending upon which stats you look at. And the reality of that is there's been a race to the bottom in terms of the covenants that are provided, the coupons that are earned, et cetera, to the point where I would say a lot of that lending doesn't look that different to what actually exists in the bank syndicated lending market. If you look at where we are in the cycle today, people like to cite a very artificially deflated default rates. And I'm really going to speak about the United States in terms of numbers here. But the reason for that is in public markets, you have what are called liability management exercises, which is that borrowers go to lenders and say, we know you owe your par. We want to pay you 80 cents, and we're going to play games underneath our documents to make that work. So when you add in liability management exercises, you have a middle single-digit default rate for the last 2 years, and I think that is the real rate of defaults in the public markets. In the private markets, it's a little bit different because there's only a handful of lenders. So they say, you know what? We know you owe us cash interest. We're just going to pick that interest, and we're going to pretend it's meant to be picked the entire time. So when you look at non-voluntary PIK interest in those markets, again, you're at mid-single-digit default rates. And if you were to go back to the 2000s, which was a market that was really a market of bank syndicated lending, that was the average default rate in the 2000s in an interest rate environment that's similar to today. So I think that rates of return on this asset class were dramatically overstated the last few years, and I really mean private credit. People talked about double-digit interest rates, which maybe you could earn for a year or two in 2022 or 2023, but this is really a middle single-digit asset return class. And you've already seen this response in public markets. If you look at BDCs, they've traded down dramatically this year, and they're now trading at discounts, which historically is where BDCs traded, not at modest premiums. So the public market is already reacting to this. The reality is it will probably take a while in the private markets for people to show this in their marks, but that's where things are. Similar, I think, to the two firms here, we are doing loans that are much, we take on a little bit more risk for a lot more return simplistically in our loans, or we take on a lot more complexity sometimes in our loans, and you don't take on that much more risk. So we're typically doing double-digit type lending in what we're doing. That's a very different market. I would say that market is far less saturated than the direct corporate lending, or in the asset-backed world, the investment grade market is. And so the supply-demand dynamics in that market are actually much better, quite frankly, in part because there's been a lot more competition. And I think for some of the reasons that I spoke about with what's going on in the broader markets, it's actually creating more opportunities, not less.
Okay, thank you. So moving to the China region, Chris, your fund has China tilt, Asia focus. So what do you find interesting in these markets for the deployment of capital?
Yeah, I mean, we're most of our funds are regional, so we're constantly looking at the relative attractiveness of opportunities across the region. And that adjusts, right? As a cycle changes, as opportunities, we shift between them. In China today, we are leaning in on the public equity side. We've seen very strong dispersion. Our equity long short portfolio manager has been doing phenomenally well. We've been leaning in on convertible bonds. There's been a lot of issuance of very, very high quality companies. I think this is something that's not really appreciated. Now, Asian convertible bond market is now much larger than Europe, and 80% is large cap investment grade. So, Asian convertible bonds, if you look at the biggest issuers this year, Ping An, Alibaba, in the US, they're mostly crypto companies. So again, I think this is something which not many people have fully realized yet is the markets, and obviously Hong Kong, China are the biggest part of that. The depth, liquidity, and quality of companies is been increasing all the time. So I think that's really still a long-term trend. We're less active on credit side in China. A big part of the credit universe in China was always also the property sector, where there's still a lot of balance sheet repair going on. And right now, interest rates in China are low, so anyone credit worthy can borrow very cheaply. So on the private debt side, China's not very interesting. And then we're active on the buyout side and private equity as well. We like China, actually. Valuations are cheap, debt is cheap, there's almost zero competition, and there's some great companies. So, so very much in China, we're very much equity focused, public and private. We are less active on the private credit side and less active on the real estate equity side as well.
Okay. Nicolas, how about your firm in terms of deployment to the region or China?
Yes, I think our focus on the region has really been focused in China has been around the Hong Kong market, indeed convertible bonds, long short equities, and it is currently a reasonably small portion of our allocation. We've been invested also in Japan for a very long time, and that has been an area of the market that's taken a big proportion of our general fund allocation and of our private capital deployment with this corporate governance transition, which is a very long-term opportunity set for us to capitalize on.
Okay, thank you. And Tony, China versus India, your firm has a view on that in terms of capital deployment.
Yeah, it depends on maybe which asset class. So first of all, we've been investing in China for a long time, not as long as some of these folks, but for a reasonably long time. And we actually opened our Shenzhen office in, I think, 2021 during the middle of the pandemic, which was certainly a bit contrarian at that period of time. I would say in China, there's really been two places we've been focused. We do a lot of public bonds in China, so a lot of opportunistic credit, but really in the secondary market. We've done a little bit of directing lending there, but it's a smaller part of it. And then I will echo Chris's comments. The convertible arbitrage market in China specifically and in Asia in general, we think is a fantastic opportunity set. I will say there is more going on in U.S. converts just beyond crypto, but the Asian market's really, really strong in terms of a place to invest. We've been doing a lot in India in direct lending. Probably if you were to just look at what we're doing on the opportunistic credit side, we're more active in India today than we are in China, which is not to say that China's not a good market. It's just India, there's more going on. But India does not have the convert market or some of the other factors that we can invest in China.
Great. Okay, thank you. I'd like to, take a step back and bigger picture. So the subject of this conference is tracking through shifting terrain. And, the IMF recently released their latest financial stability report, which they named Shifting Ground Beneath the Calm. So a lot of terrain analogies here. And one of the risks that they highlighted was the risk of non-bank financial institutions and the exposure that deposit-taking entities have towards non-financial institutions like hedge funds. And the figure they cited was close to $4.5 trillion US dollars. So I know each of you can only speak about your own firms, but in terms of how you think about a important systemic event taking place in your industry, I mean, how would you assess that risk, Nicolas?
I mean, as always, the risk to the system as well are when there's not enough loss-absorbing capital, and that tends to be correlate. And that's what creates a risk when the losses do come. If you just can't absorb them, and that's typically because they're levered, and when the hit ultimately hits the leverage providers, Our portfolio is very conservatively structured. Our long assets over equity are 120% only of equity. So the idea that hedge funds, I think, like the ones that are at this table, would create a systematic risk exposure is very low. But there are a number of big trades, especially around fixed income arbitrage in the world, which do have the capacity to create systems, but to create systematic risk. Having said that, there's such large systematic risk that they might trigger the intervention of monetary authorities. And by and large, I would say that certainly in the private credit world, there's plenty of I feel like there's plenty of loss-absorbing capital there, i.e., the investors in the fund directly might have to bear losses, but it's hard to imagine that the banking institutions that are providing the leverage there would be at risk.
Right. Okay. Chris, any views?
I think certainly from the private debt side, my general feeling is the sector is not quite big enough yet to be really a systemic risk, but I think there are areas that need watching. I think liquidity mismatches is one, private debt being funded through open-ended vehicles, and there are even private debt firms, in Australia funding themselves with daily liquidity retail funds. So I think always when there's a liquidity mismatch, that needs to be watched. I think it was mentioned yesterday, the insurance, using insurance to fund private debt and other alternatives. I think that needs to be watched carefully by the insurance regulator. I think there are also some maybe less institutional private debt firms. Again, in Australia, there's an example, there's been sort of a few sort of scandals in the papers recently of private debt firms, lending to their own projects, charging excessive fees, etc. So, I think probably needs to be a little bit more oversight and regulation as well. But my feeling is it's not big enough yet, but I think there's some areas to watch probably.
Okay, Tony?
Yeah, I mean, look, there's the great Warren Buffett saying that when the tide goes out, you figure out who's been swimming naked. And there's always a little bit of that when markets retract. I mean, look, if you want to poke holes in asset classes, you can find them. So in the absolute return segment, again, the firms that are up here use very little or no leverage. There is a whole universe of funds that are levered 5 times or 8 times, and that's when accidents tend to happen, is when you magnify risk and leverage. I mean, I've been reminded a lot of the long-term capital blow-up in 1998. That was a leverage story. A lot of those were basis trades that ultimately would have worked out, but they just put too much leverage on them, and in that case, the financial system was not willing to absorb the losses. You know, in the private credit world, you've had a recent bankruptcy in the U.S. called First Brands, which has gotten a lot of attention. It's in no way, shape, or form systemic, but relative to what's not particularly a large capital structure, it's gotten a tremendous amount of publicity. And some of that relates to people who were doing factor receivable investing, and they were probably telling their investors they had Walmart receivables, but it turns out they had First Brands risk, and a lot of that stuff may be worth zero at the end of the day. So, you know, these things do go in different ways. But in terms of like what's going to be more systemic, I worry much more about things like potential overvaluation in equity markets, right? Money chasing things like AI that may indeed be a transformative technology. You know, I listened to a number of the sessions yesterday, and people were comparing AI investment to the railroads, basically saying, don't worry, a few companies will go bad, but it'll all work out. There were many large financial panics in the United States in the second half of the 19th century and the first part of the 20th century involving the railroads. And the railroads were a massive value-destructing thing for investors in the entire lifetime. No one ever made any money in the railroads. It was great for the United States to have a railroad system. It was absolutely terrible for investors. So this idea that we're going to have some winners and losers and it's all going to work out, like, just think about that. Like, it may work out over a very long period of time, but you could have massive carnage getting from here to there. So that's probably not the best analogy for people to be using.
Okay, thank you very much. So I'd like to express my thanks to our panelists, and thank you very much.
Thank you, Mark.